Thanks very much to everybody in the room and those of you who are online for joining us for this panel, which has a very topical title called Money, Money, Money. Is the US dollar dominance under threat? Very interesting topical conversation given the address that has preceded us. I will allow my fellow panelists to introduce themselves, and I will start next to me, Benjamin.
Hey, I'm Ben Duve. I work for GK8 by Galaxy. I'm the global head of partnerships. GK8 is a crypto custody solution of Galaxy Digital. In my former life, I was a central banker. I was at a large American bank, BNY. I ran a custody business at Commerce Bank. I did also some commercial banking there, many other things. So I think I span quite a bit of the topics relevant for the panel here. So looking forward to the discussion. Thanks for having me. Thanks for listening.
Hello, everyone. Obviously, I'm Sandra Ro, but I'm going to wear a different hat today. Most people may not be aware, I'm actually a former banker that traded most currencies you could imagine. I spent time at Deutsche Bank on the trading floor, as well as Morgan Stanley, and then I ran FX, research and product development for CME globally. So I will come at it from my foreign exchange experience.
Thank you. Januš.
Hello, good afternoon. My name is Januš Kizenevič. I am former banker, actually. I spent 11 years working in corporate banking, specifically risk management, new products development, new solutions, and tech capabilities. Last year, after 11 years, I came back to my country, Lithuania, and for the first time I accepted public role in public sector, and I am now Deputy Minister of Finance of Lithuania.
Thank you. Thank you all for joining us for this panel today. I'm going to open with a very wide sweeping statement, and I'll come to you first, Ben. Is the US dollar losing dominance?
Well, let me come from a very digital perspective there, right? If you look at stablecoin adoption and adoption in the digital world, it actually exceeds tremendously what we see in the what I call the real world, the real economy. I think there's around 20% of the world, for example, is trading using euro, right, for the flows. But if you look at the digital world, the digital realm, it's 99% dollar-denominated stablecoins. All the transaction discussions in another room where people talked about euro-based stablecoins, which from a company perspective is a great use case, because if you go from 0 to 20% of global trade, I mean, there's a great business case, right? But if you look from a macro level, I don't know who uses it, right? If you're honest, I mean, we had the discussion, we want a better euro-based stablecoin to transact in, and I said, which liquidity pool in crypto, for example, does want euro? They all sit in jurisdictions where dollar is the preferred currency. The deepest liquidity pools are dollars. And now if you go one step further, because before we talked a little bit about the real world adoption and how it goes into day-to-day life, everybody uses Tether, right? So it's a stable coin based on US treasuries. So indirectly, 100% US dollars, right? And I think it's a very interesting one. Then with regulation coming, more dollar stable coins pushing out retail and so on, I think it's a very interesting mix. And right now, I don't see any threat to dollar dominance.
Any threat, generally you said, but also you particularly mentioned in the digital assets ecosystem where you have absolute dollar dominance. Januš, please give us your thoughts on the dominance of the dollar and maybe other ecosystems.
Yeah, so it's very complex, actually, question, and we can go deep and deep and deep in this. But when you look at numbers, and numbers don't lie, we still see really huge dominance in every area, in almost every space, but this traditional, safe, regulated space. And I checked some numbers. I think numbers are valid, and it's good to refresh sometimes from time to time. So, for example, USD still accounts for 59% of global foreign exchange reserves. Yes, it was 71 in 1999, but really world changed a lot. In global payments, it used around roughly 50% of SWIFT transactions. Okay, we can negotiate here. It's dropping or not dropping, and the future about SWIFT also. It's not one opinion. And of course, the largest piece is foreign exchange trading, and it's 89%. So this is, I think, a fundamental thing where we can kick off our conversation. And at the moment, yes, we can say that dominance is slowly eroding, very slowly, but at the moment I don't see any critical shift, any critical movement on the horizon. Yes, there are some forecasts, some expectations, and I think we will direct our conversation also more to digital assets and all these related aspects.
Absolutely, thank you. Sandra, we seem to have agreement, but do you want to just bring in some differentiator between maybe wholesale and retail markets?
Sure, but before I do that, I do want to unpack, when we look at dollar dominance, there are a number of metrics that I would recommend we consider using. Number one is 7 trillion or so goes through the FX markets. I'm talking about fiat FX market every day, which makes the stablecoin market look this big on a relative basis right now. And the derivatives markets are included in that number. And again, it's dominated by fiat currencies, of which 87, 89% of each FX leg, the dollar is there. So it's clear dominance today. But here is where I would start looking at erosion. Erosion is global payments. Erosion is commodities. Most commodities and trade is dollarized. But when the petrodollar no longer becomes the petrodollar, when derivatives, for whatever reason, may be marked as not as dollar underlying, that is when you're going to start to see those shifts. Gold, for example, is dollarized for the most part. Most commodities are dollarized for the most part. But when you start seeing shifts in that, that should give you pause. And it has actually already started. So in China, between Africa and South America, a lot of the invoicing is done in renminbi. And that shift has been going on for a very, very long time. So trade is another flashpoint. Derivative markets, another flashpoint. So to get to your point about wholesale versus retail, I think we have completely different dynamics that are going on, and I'll let Ben point out where he thinks we might see some major frictions. So dollar erosion, I think, actually is at risk, particularly in the commodities sector on global trade, especially with what's going on geopolitically.
Well, I think that there is a very specific aspect in that retail versus wholesale. But one thing to say, just with Venezuela as the largest exporter of oil going back fully on the dollar, I'm not really sure we see a commodity shift, and depending how the situation in the Middle East pans out, there might be a need or want for reassurance of American assistance and friendship, and that normally comes with petrodollars. So let's see how that pans out. But I agree, I think there's always a threat, there's always a discussion, been also in the Middle East recently, and when you talk to people in sovereign wealth funds and others, there is this understanding, do we go to other currencies? But then again, people looked at the Euroclear discussion in Europe, and then what's the other safe asset? I don't think renminbi investments in a not freely traded currency is an alternative, right? So I think that's an interesting, if you want to chime in on that, and I get to the other point then.
You touched good points. So I think it's the question, is commodity and transaction is covered by soft power or hard power. So it depends. And yes, in some countries they are willing to change and to exchange and reduce dollar transactions, but they think that it's covered by soft power. Where it's hard power, I think it's slightly different opinion.
Fully agree. So I just want to take that little detour because it's such an interesting discussion, right? And then if you look in that purely digital realm and where that could become a challenge is when we see the dollar dominant strategy in that digital arena, in the stablecoin arena, and it's very clearly deployed in that manner, right? Whole genius discussion, yield or inducements or whatever around it or not is also a competitive question. It's a banking question, and I think in Europe we solved it by saying no, because we don't want to drain bank deposits. But in the US it's a more mixed picture, because one part is we want to not drain the reserves and the savings from the banks completely. But on the other hand, yield means on dollar an inflow of global savings into US treasuries, because what happens? If you are able to access fully US regulated and issued stablecoin as a private individual across the world, you have a currency that might be much safer than your local currency. And if yield is being paid, it might be the first time for you where you have access to some kind of investment, and the investment is actually then US treasuries. So that's an interesting one, right? Now, if we go a step further, and we don't know how it pans out, right? So we don't know the result yet, and that means how attractive is it or not. But I think the move on a retail side to dollars is very strong, and stablecoins make it, US regulated stablecoins with the government looking at reserves and everything, make it a very safe alternative. And then what does happen, and we discussed it before as well a bit. Let's see, there is a shift in commodities, in corporates, in other areas, right?
So the point that you raised about retail driving stablecoin adoption, which is predominantly US dollar, which is 99.9, let's face it, it's US dollar.
Yes.
That is actually problematic, because if you think about it at the wholesale level, that adoption is nowhere near those levels, though they are trying to penetrate the institutional markets. They have not. And at some point, if you are a government that does not want dollar dominance, and you would like to issue a digital version, but you haven't yet, and it's not percolating through your system, and you tell all your banks and all of your corporates, do not accept stablecoin because it's dollarized, you inherently have some level of friction, because your retail market is probably adopting it. And this is where it's going to get interesting between what I would call wholesale versus retail.
Yeah, the moment you sell a product, right?
There will be different incentives for why someone wants to use a product.
But if I buy something from a corporate, a commodity, for example, I want to pay in what I have, and it's a stable coin, dollar-based.
But if I don't accept it, then what are you going to do?
That's the question. Who wins or loses, right? I think that's the question in that scenario is, other than companies or corporates in the country say, I'm smart, I see a market, right? That's capitalism, as long as it's fairly free. And then you say, hey, I have a dollar stablecoin, and company A accepts my stablecoin, however tricky means they manage, and the other company does not. I choose the, and I think those are market forces. And I believe the real problem there also is it creates whatever you call it, FX friction, because if you at the corporate level do not deal in dollars, but you receive dollars on a constant basis, you inherently have a constant FX risk or the need for conversion. And I think that's another problem you just put in those economies.
So Ben, thank you. You've articulated lots of different points there. Let me just bring Januš into the conversation.
But again, about risks, so regulators doing everything what they can to manage or limit risks. And I totally agree with you that what you mentioned before, technology is really currency neutral. So at one moment, at one time, regulators really start checking and verifying, do we really need to to not only invest in technology, but because this is happening, but how we will be reducing and managing risks with all new technology-based systems, not institutional-based, because now it's old-fashioned understanding, but technology and infrastructure-based.
Yeah, absolutely. And that risk is something that if we see the rise of the world as you've outlined it, Ben, that regulators are going to be mindful and conscious of and looking for solutions that mitigate those risks. But Sandra, can I just take you back, because you mentioned trade and you mentioned commodities, and obviously we are living in a world where, you know, deals are done, trade flows between countries, and how do you see that evolving given the geopolitics and the use of the dollar within those arrangements?
So for the last year in particular, every region we have gone to has world leaders in their respective jurisdictions saying we will have to reassess with whom we trade. Regional blocs like Southeast Asia are strengthening trading amongst themselves, trading with Africa, trading with India. These conversations, though it's not today that it's going to all of a sudden flip a switch and dollar is gone, I'm not trying to say that. But the fact that these trade deals are happening without a US involvement should indicate to everyone there is a trend and a realignment going on. There is a global reassessing of who your friends are, let's be very frank, and who you want to do business with. And Southeast Asia is, these are the conversations we've had very recently. They are strengthening their ties. Now, which currency, will it be Malaysian ringgit or Singapore dollar? I don't think that's the point. They're actually debating whether they have their own common trade dollar equivalent. But we're going to have a proliferation of figuring out how to settle things by a region or by bilaterally that may have nothing to do with dollar. That's all I'm trying to say. And I am taking the what is at dollar risk standpoint just to mix it up.
Absolutely. And taking that forward, I mean, all of these regions are looking at their own currencies, their own digital versions. We have the proposal for a digital euro. I mean, if you lived in a world in which, I know that everybody on this panel is saying we don't see a change in the dominance of the dollar now, it might change in the future, but be very, very slow. But if this was a totally different world, a hypothetical world, and you had to reimagine it, what do you think that might look like? Or what do you think would be the drivers that really makes a change? We've talked about trade, but is there anything else that you think could actually make a real sea change to how the world currently works?
It's all about diversification and how to diversify and manage risks at the same time. I can be a big fan of digital euro, and I think we can find more fans of digital euro. And what is positive that we already achieved 45% of instant payment in Eurozone, so this sounds really promising. But in reality, when you look globally, it's more than 130 jurisdictions are currently verifying, adopting, analyzing their digital currency. And of course we need this. But it's not about de-dollarization. I would say it's more about de-concentration and how to diversify, how to put more options on the table in a very simple language. But do I expect major shift? No, because new digital currencies will not bring natural demand and supply. That's why dollar in this understanding, USD, I do believe it stay quite strong and quite stable, no matter how many countries and jurisdictions will adapt and implement the digital currencies.
maybe to not sound too negative, let's add two components to it from a European perspective, right? There's two things. There's a wholesale digital currency and there's a retail digital currency. So I think from a wholesale perspective, Europe has a huge opportunity to create a actual digital version, and it already exists because banks already have accounts at the central bank, Target 2, so they actually have a digital version of the currency, but in a format that's actually then used in that digital environment for settlement and so on. So on the wholesale side, there's a huge opportunity to use the currency as well as other innovations to drive efficiencies and make a system better. But I think the majority of that is more internal and more market efficiency and hopefully strengthening and deepening of markets. It's not an expansionist version, right? So I think it just is there to maintain and optimize the status quo, right? On the retail side, there is actually no challenge to what's currently done by the US, right? The digital euro we have is deliberately designed to only be used within Europe, right? So it's a currency only used to transact within Europe and deliberately done in a way that you cannot transact outside for various reasons, control, illicit use, and so on. But that means the digital euro is not an answer on the retail side, is not an answer to dollar dominance. And then we have a second piece, which is European-based stablecoins, nicely regulate everything. How can they compete? They can pay interest, and we don't know if a US dollar can pay interest or not, but they can pay interest. But secondly is, what is it? A euro-based stablecoin is not equivalent to the euro. Because a euro-based stablecoin has bank deposits and then buys debt from different countries, for example, or a bouquet of debt. But that doesn't represent the same risk than a claim against the European Central Bank. Because, and for people who are not in finance too deeply, there are banks are differently safe in different countries, and countries are more or less likely, and that was the euro crisis, are more or less likely, at least expected by the market, to be potentially failing, have too much debt, and so on. So as a stable coin euro, you don't know, is this a stable coin who has deposits in the most shaky banks who pay the highest yields in Europe, combined with the lowest rated but highest yielding sovereign debt. And that could mean you have a stable coin whose risk is much, much higher than the risk profile of the real euro. So even you can't even compete from that perspective because we don't have, and that's the construction problem maybe of Europe to a certain extent, we don't have a common debt by the central bank or anybody else you can use as a backing for the stablecoin to make it equivalent to the actual euro.
So, but if I just come in and add there, and I'll open up the question. You've talked about the digital euro, you've talked about a euro stable coin, but what about if you bring tokenized deposits into the equation from the points you've just made? How does that move the dial in any way?
But tokenized deposits are exchanged usually between clients of those respective banks. So do you onboard everyone in around the world? I worked at a bank. That's very expensive. And I mean, we cut off certain kinds. So I think the deposit, so I think, and that's a personal opinion, right? Tokenized deposits are a way for banks to transact among each other on top of their old legacy infrastructure. So it's a pure efficiency play. It has nothing to do with currency expansion or anything. It's basically just, hey, our systems are so bad, but we want to do more with each other. Let's put a better digital layer on top, and then we can still have the underlying systems, but we can better transact with each other.
Yeah, I would tend to agree with that. I think there will be a world where we will have tokenized deposits, stable coins, and fiat currencies will remain. The issue will be actually from a legal rights and regulatory standpoint, what are those things legally? What rights do you have as the owner or the holder of these things? And they're not necessarily one for one, even if a stable coin is supposed to be dollar backed, or if it's not, or sorry, euro backed, if it doesn't have the same rights as you would have holding the euro, why would you in your right mind? This is the debate, by the way, we're having, not to go too far off tangent, but tokenized equity, securities. If they don't have the same rights as the underlying, you have to, one, disclose that as the issuer, and number two, then it's not a truly one for one. And this is where I think there's a lot of hype around tokenizing everything, but you actually have to get down to the levels of legal, jurisdictional, regulatory parameters that may actually create differences between what you have. And that creates new risks.
I think very tough debates are coming to the regulators' rooms because there is no simple action, and the final decisions will be connected to the level of trust and understanding, deep understanding. Yes, some regulators really are very advanced, and they are trying to be, 2-3 steps forward, but again, not everyone. We have huge countries where regulators are extremely careful, slow, and they're not interested, to diversify and to put more options on the table. So I think, unfortunately, trust will be very limited in this type of sophisticated, let's say, solutions.
And I think just to come back on the point you've made, trust is absolutely important, particularly when we're talking about retail payments. And we are going to face this challenge where you have these different protections. But we've slightly gone off base because you're all quite agreed about dollar dominance. So how do you think, and I mean, as a policymaker, Januš, this is obviously going to be of a concern to you and other regulators across Europe. How do you see that being addressed as we move forward?
To be optimistic. No, we are too slow, if to be honest with you, because we are definitely, now what we are doing, we are reacting what is happening in the US, and it's not good because the reaction, it's not always worse, but reaction makes that you have limited options, and the music is playing, but you have to dance, and other countries set the music. So I think, yes, there are some understanding why we really need and what is happening now across European Union countries. Very tough debates about digital euro, about privacy, about security, and not everyone is happy. Not every society really has that literacy level to understand risks and opportunities. So yes, regulators and policymakers play a critical role in investing and educating, not only risk management, but also educating about opportunities.
Sandra.
So anyone who trades any markets knows there's one fundamental rule: liquidity. If you don't have liquidity, it just doesn't matter. Go home. Yeah, you're dead. And I've been in markets where things have literally, liquidity has disappeared. You can't do anything. For Europe, if there's going to be a digital version, whether it be a stable coin or a euro, I won't go into that, to compete against dollar, you have to unleash the ability to innovate within certain parameters, and you have to allow the banks to do it. You have to allow entrepreneurs and whatever stablecoin companies that are out there to do it. Without that, I just fear that the dollar dominance of 99.9% in stablecoin right now, it will just remain, and it will proliferate throughout the world. And this is the reality on the digital side. So the growth. So today, fiat is bigger. Digital version is small, but it's growing at a very fast clip. It is starting to seep into the institutional wholesale side, or at least is trying to. And retail is taking it up at a rate that is actually phenomenal. In Nigeria, 25% of retail supposedly holds, or the population supposedly holds, some form of crypto and stablecoin. It's astonishing. So again, my view is time. You're right, Januš. It's too slow what Europe is doing. You've got to move, and you're going to make mistakes, but that's got to be okay. And this is where I think is the only way you're going to fight against dollar dominance in the digital world.
I think there's another component, which also painting a more positive picture is, if you look at the wholesale side of things, I mean, I was in the central bank 2 years ago, almost, and we started to work on how does the future of wholesale capital markets look like. Now it's called APIA, so it's public, so I partly can talk about it, but that means already 2 years ago, and if you look at when US policy changed, that's long time before that, we had trials and experiments around wholesale digital euro applications. We wrote and have a strategy started around how does wholesale DLT and DLT, however you want to call it, digital assets-based capital market look like, including the wholesale digital euro. And we now already see that that is progressing, and that policymakers and the ECB will progress on these topics. So I think there are topics where we are years ahead, right? And I think if you look at the ban on CBDCs in the US, there will probably also not be a real catch-up in that arena. So I think the opportunity to innovate, to test, and to probably gain certain efficiencies around that could be a true driver for Europe, deepen capital markets, increase liquidity. And I think the difference is and I think that's a key one, if you have a wholesale version of your currency by the same issuer, the central bank, you don't fragment it, liquidity pools if the central bank has a specific view on that. Because the central bank can control, and usually, like in Europe today, T2S, controls the systems where central bank money can be used and makes the rules around it. So they are actually in a position to impose rules and standards which prevent liquidity fragmentation. So at least it should have the same liquidity as now if they manage to link the old and the new.
So that brings us back to the same debate we're going to have, though. If government can force all of the banks that are regulated to do something, they can. And that liquidity will be there, and there will be some level of efficiency or whatever it is that happens at the wholesale level. But retail will go with what is best. And if they are able to get a hold of stablecoin in dollars, they will do so. And then you will have that friction between what's going on in the wholesale markets versus what's going on in retail. And the rate of change of adoption at retail is something that every policymaker needs to be worried about.
I only talk about within Europe, right?
Yeah,
so
yeah.
What I talk is not expansionist, right? It will not drive outside of Europe, agreed.
Maybe you should.
But I think the turnkey argument is, I don't think, and probably some people here hold US dollar stablecoins, but they hold that to transact in crypto. But I think nobody or let's say not never, but it's very unlikely that the average European consumer will switch to a dollar-based payment structure based on US dollar stablecoins, right? So I think the threat is not to Europe. The threat to Europe is more the wholesale market, is more around, does capital not get allocated, and does liquidity not stay in Europe? I mean, that's a wholesale threat. But I think the stablecoin adoption is a world problem, not really European. I never buy that argument, because I never in my life opened and I travel a lot. I lived in the States. I worked for an American company. So I, in theory, of all the boxes you have, I never in my life opened a US dollar-based account, right, in living in Europe. So I normally would have been the first use case to have it. I don't. So because it's so easy, convenient, I use my credit card, and then I use a different credit card to do auto FX, and then the one is cheaper, better exchange rate. So I don't.
But that's you in Europe, and also interacting with US, you figured out ways to do it. I'm talking about the rest of the world, who, by the way, has Gen Z population that represents about a third of the world population. and they're sitting in a lot of growth markets. And those are the kids, I'm going to say some of them are kids, who are literally, because they have phones, are driving this absolute exponential growth rate to stablecoin adoption. Also because their local currency is not trusted and it's not stable. And that is another factor in why dollar stablecoin is being adopted. So I'm just saying there's a whole confluence of Europe may be able to still keep euro in its form to some degree and some liquidity, but digital dollar dominance is a problem. We probably should have put digital dollar dominance on the rise. That is the issue, not dollar as in
dominance.
fiat. Yeah.
Absolutely. And now I am conscious of time, and Emma is waving at me. So, Januš, I'm going to give you the last few words on our panel before we wrap up.
So I'm not only Lithuanian, but also European, and I love my continent. I love Europe, but Europe is getting smaller. So don't forget about this, that Europe is getting smaller on this huge global map. And yes, we can protect our system. I totally agree. We have safe system, but in longer perspective, Europe must go faster. This is the thing, because we can expect that the US will do everything to protect dollar, and this will not be a surprise. But on consumer side, again, more options you have, more safe you are, and regulators will have very tough debates and discussions what to do with this. But deconcentration, I would say, this is the main thing, and this is the biggest focus.
Thank you very much. Ladies and gentlemen, I hope you've enjoyed the conversation amongst my panelists who've given you some food for thought. They are, of course, agreed that we will see the rise of digital dollar dominance, but maybe we'll have a similar conversation again next year and just see if Europe has moved fast and changed the dial on anything. Please, in the usual way, thank my panelists.